Hello everybody, in this video today we're going to be talking about the gross profit ratio and how it can be used to analyse the profitability of a business. There are three ratios we're going to be focusing on this term. The first one is the profitability ratio, that's what this video is about. You'll also do the net profit ratio and the return on equity ratio. And those are three important measures to determine how profitable your business is. So the gross profit ratio is looking at basically three accounts. The first one is your sales. And if I start now as if I was doing a statement of profit or loss, just the beginning, the extract. So I would start here with sales. That would be the first thing I'd list. And I'm going to use really easy numbers to start with, really small numbers to make it make more sense. So let's start with $50. Let's say that you have $50 in sales. Let's say that we're an ice cream store. I have $50 in sales. Then, in the statement of profit or loss, I would now take off any sales returns. So it's going to be less sales returns. Let's say that they were $10. Let's say $10 were returned to me. So this means something was faulty with the ice cream. I've given it to customers, there's something wrong with it, they've returned it to me. So maybe the ice cream just tasted a little bit weird, tasted a little bit off, and as a result, they've returned the product to me. So then I would work out what my net sales is going to be. So net sales, the formula for that is sales minus sales returns. So I would work that out. I'd put a line underneath here and I would go 50 minus 10, which is $40. And this number here, I'll just show you there. This represents our net sales. So this $40 is my net sales. And that is sales minus sales returns. Then, from that, I use my next account that's used in this calculation, which is my cost of goods sold. This is what it cost me to make the ice cream. Maybe I bought it already. There's two ways I could get this ice cream. One, I could buy it already from an existing supplier that makes all of the ice cream, or I could make it myself. Either way, the cost of making the ice cream, including things like the packaging, if it comes with a cone or a cup, some napkins, that would all go in cost of goods sold. So I'm also going to subtract cost of goods sold. Less cost of goods sold. And let's say in this example that was $20. Let's say it was 20, because $20 is what it would cost me to make that amount of ice cream or to buy it. And then I would work out my gross profit by subtracting the 20 from the 40, which would give me $20 left over. And this number here would represent my gross profit. So the gross profit ratio then is looking at the relationship between gross profit and sales. Remember, ratios are looking at two numbers in relationship with each other. So my gross profit ratio in this particular example, the way I would work out my gross profit ratio is gross profit ratio the gross profit ratio equals, when I'm looking at this, it is going to be my gross profit divided by my net sales. And if you want to express that as a percentage, you also times it by 100. So let's substitute those numbers from this fictional example of my ice cream store into my calculation here. So now I'm going to get my gross profit, which as I can see up here is 20, divided by my net sales is the 40. Don't take the 50, because net sales is when you subtract the sales returns. So I need to go up to 40, divided by 40, times by 100. And if you put that into your calculator, if you go 20 divided by 40 times by 100, you're going to get 50. That means 50%. So your gross profit ratio in this example is 50%. Another way you could say that is if you don't times it by 100, you'll just get 0.5. And what that means is that from each dollar of sales, net sales, from each dollar of net sales, the business is keeping 50 cents in gross profit. You want this number to be higher. Higher tends to be better and more profitable because it means your gross profit is high in comparison with the amount of sales that you're making. But how do I know what a good number is? Well, there's two things you want to compare this number with. Firstly, you want to have a look and see what it is this year compared to what it was last year. And then you also want to compare it to what others in the industry are doing. And the advantage of a ratio is I could compare my ice cream store to a big company like Baskin-Robbins, even though Baskin-Robbins are going to have a lot more sales than I am, and it's pretty hard if I just look at their sales or their profit figure and compare it to my profit. This is going to be a lot higher. But if I look at my gross profit ratio, it allows me to compare myself with Baskin-Robbins and compare my ice cream store with a big branded ice cream store, even though they might have a lot higher sales than I do, because they have a bigger market share, as in they're selling to more of the market than what I am, if I just have one small little ice cream store. So what does it indicate if you get a ratio that is high? A high ratio means that you're really effective at your core business activities of buying the ice cream and selling it at a higher price. It also means that you've got a good selling price margin, and that is the markup on your products and services. It means that my selling price is high comparative to what it costs me to make that specific product. And this is the starting point of everything too. Having a good gross profit puts you in a good position to earn a really good net profit and return to owner. This is the starting point. Without this, it's really hard to get a good net profit and a good return on to the owner if you're not getting a good amount of gross profit from the sales that you're getting. So what does it mean if you have a low gross profit? It's essentially the opposite of everything I just said. It means you're not as effective at your core business activities of buying and selling ice cream than you were in the past, or than compared to what your competitors are doing. It also means that you're in a worse off situation, and it makes it harder for you to earn an acceptable net profit and return to the owner. You're less able to face adverse economic circumstances, such as the global pandemic situation that we're currently in right now. When you're looking at this ratio, you also need to identify why it might have changed throughout the year. And the way you see that is you look at what's happened to these accounts. You look at what happened to sales, what happened to sales returns, and what happened to cost of goods sold. You want sales to be high, and you want sales to be high, but you want sales returns to be low, and you want cost of goods sold to be low. Because you want to be getting lots of sales, but you don't want to be getting many sales returns or cost of goods sold. You want those to be lower. It's not a bad thing though if your cost of goods sold goes up. That's expected if your sales go up. If you're selling more ice cream, it's obviously going to cost you more to get that ice cream than if you were selling less ice cream. So it's all about how much cost of goods sold goes up by in comparison with how much sales has gone up by. So what can you do to improve this ratio? Well, obviously you want sales to go up. How can you do that? Well, you can advertise. You could conduct some market research to see what's going to be popular, and in that case, try to do something that's going to increase your advertising. Sales returns, how do you decrease that? Well, you make sure you've got a high quality product that doesn't need to be returned. You can't say you just want to have, with sales returns, I'll just never give anyone any products back. I'll never let them return anything. You can't do that. Consumer law means you have to give people a refund if there's something faulty with the product. But say they just change their mind, maybe you could offer them a store credit instead. If they don't like their ice cream, for whatever reason, maybe you could just give them a different one rather than giving them their money back. And cost of goods sold, what can you do there? Well, you can look around and investigate the possibility of finding yourself a cheaper supplier. That could work. See if you can bulk buy things in bulk to save money that way, or see if you can pay cash for things rather than credit and see if that gives you a discount. They'll give you a discount if you pay for it with cash rather than on card. The only other thing I can think of is increasing sales. You could increase the selling price. If you do that, you're selling your ice cream for a higher amount of money, which means you're getting more gross profit on each product that you're selling. But that would need to be done with caution, because if I start suddenly trying to charge $10 for my ice cream when I used to charge $2, it's going to turn a lot of customers off and I might lose a lot of demand for my product. So sometimes actually lowering the price could be an effective strategy, because if I lower my price, remember supply and demand would mean that lower price means higher demand and I might be selling more product. And that would be a useful way of improving this as well, in improving my gross profit. So hopefully that made sense to you. If you do have any questions, please let me know, and I'll see you next time. Thanks. Bye.